This week marks a first for the Wizolver portfolio. 0 new trades. In this video, I'll show you what the market actually did this week. The full watch list I was working from, why every single setup got rejected, and one dramatic move in a popular wheel stock that shows exactly why premium alone is never enough. Let's get into it. Volatility stayed moderate this week. The VIX held near the 18 area, even with some recent weakness underneath the surface. That matters, because premium was still available. But this was not a high volatility environment where risk gets automatically compensated. Elevated premium requires elevated caution. Normal premium requires normal caution. There's no free lunch either way. SPY continued to hold its broader uptrend, staying above major support. QQQ told a slightly different story, breaking below its short-term structure before staging a sharp rebound. The broader trend remained constructive, but short-term momentum had clearly weakened. And then there was the calendar. This week was dominated by mega-cap earnings. Microsoft, Meta, Apple, Amazon, all reporting within days of each other. Event risk was elevated across the board. When 4 of the largest companies in the index report earnings in the same week, stock selection matters more than market direction. The index can look calm while individual names gap 10, 15, 20% overnight. The environment still favored selective premium selling. But earnings risk was the primary filter this week, not volatility. Every week I publish a watch list in the newsletter before the market opens. Here's what was on it this week. 7 names made the list. 3 aggressive candidates, 4 balanced candidates, and not a single safe setup. Let's go through them one by one. First up was HIMS. The idea was straightforward. I wanted to see buyers defend the $27.50 to $28 support area after the recent sell-off. If the stock stabilized there, it could become a reasonable wheel candidate. Instead, support never really proved itself. The chart kept deteriorating. Earnings were only days away, and FDA headline risk was still hanging over the stock. Could premium have looked attractive? Absolutely. But premium isn't the objective. Assignment quality is. If I'm not comfortable owning the shares through that environment, I don't sell the put. So HIMS never became a trade. Next was NTNX. This one actually did the opposite of what I was hoping for. The plan was to let price revisit the $53 to $54 support zone before evaluating a position. That never happened. Instead, buyers stepped in almost immediately and pushed the stock back toward new highs. That's bullish. But it also removes most of the edge for a new CSP. Selling puts after a breakout means collecting less premium, while accepting assignment much closer to the highs. Great stock. Wrong timing. No trade. Then there was HOG. This was already carrying elevated post-earnings risk, so I wanted to see support around $25 actually hold before doing anything. It didn't. Support failed almost immediately, and the stock continued lower. That's exactly why support levels exist inside the framework. They're not predictions. They're decision points. When support fails, the setup disappears. No trade. Moving into the balanced watch list, Bank of America was probably the cleanest chart of the group. The trend remained healthy. Earnings were already behind it. The structure stayed constructive throughout the week. The problem wasn't technical. It was the premium. This wasn't a week where I wanted to lock up capital for relatively average premium, while the entire market was waiting for 4 mega-cap earnings reports. Good company. Good chart, no edge, so I passed. Then there was Marsh and McLennan. This stock kept doing exactly what strong companies tend to do. It kept making new highs. That's great if you already own it. It's much less attractive if you're trying to initiate a wheel position. Selling puts after another breakout means accepting assignment closer to the highs, while receiving relatively little compensation for taking that risk. The chart was strong, the trade wasn't. No trade. Next was NetApp. The original plan was simple. Wait for a pullback into the 163 to 165 support area. Evaluate the structure. Then decide. The pullback never came. Instead, the stock continued climbing toward resistance. Again, strong chart. Wrong entry. No trade. Finally, Dollar Tree. This was probably the closest one. The stock did begin pulling back into an area I was interested in. But before a clean entry developed, buyers stepped back in and price recovered quickly. By the time the structure looked acceptable again, the reward for selling premium had already deteriorated. The edge was gone, no trade. And then there was the safe category. Nothing, no qualifying safe setups this week. Zero. Honestly, that probably told me more than anything else before the week even started. When even the conservative section of the watch list is empty, that's usually the market telling me to slow down, not speed up. 7 names. 7 charts. 7 different reasons to wait. That's something the trade log never shows. The trade log only records the positions that get opened. It doesn't show the setups that almost qualified. It doesn't show the names that looked interesting on Monday, but lost their edge by Wednesday. And it definitely doesn't show the trades that were rejected simply because the reward wasn't good enough. Sometimes the highest quality trade you make is the one you never place. Every one of these setups required a support level to hold and a trigger to confirm. None of them confirmed cleanly enough during a week where 4 megacaps were about to report earnings and drag correlated flows across the entire market. The framework evaluates earnings first, always. Earnings on the company itself are an automatic exclusion, while major earnings elsewhere in the market can still affect the broader risk environment. This week, event risk wasn't limited to the names on the watch list. It was systemic. When Microsoft, Meta, Apple, and Amazon report within the same window, options pricing across the board becomes distorted by hedging flows that have nothing to do with an individual company's own technical structure. So even a stock that technically held support was doing so inside a market environment where part of the premium on offer was compensating for uncertainty that had nothing to do with that business itself. That's a rejection, not because any single trigger failed, because the broader context made every trigger less trustworthy than usual. Premium is compensation, not a reason. And this week, a lot of the premium on offer wasn't compensating me for attractive assignment risk. It was compensating me for earnings week uncertainty. Those are 2 very different things. There's another piece that often gets ignored. Capital. Every cash-secured put ties up buying power. Every contract competes against every other opportunity that might appear next week or the week after. So the question isn't simply, can I collect this premium? The real question is this the best use of my capital right now? That's a much harder question to answer. And during a week like this, it matters far more than trying to squeeze out 1 extra premium payment. Let me show you what was happening while I was deciding whether to deploy capital. This week wasn't just about the mega cap earnings. Some of the names that wheel investors love to trade were making huge moves. Take IREN as an example. Earlier in the week, the stock was selling off aggressively. A lot of traders were looking at that decline and seeing opportunity. Then, just a couple of days later, one headline completely changed the narrative. The stock surged more than 30% in a single session. Same company. Different headline, completely different market reaction. That's exactly why premium alone isn't enough. High premium usually means high uncertainty. My job isn't to collect the biggest premium available. My job is to decide whether I'd actually be happy owning the business if assignment happens. If the answer isn't an immediate yes, there's no trade. Full stop. The framework doesn't try to predict whether a stock will be down 20% one day and up 30% the next. It simply refuses to participate unless the assignment itself already makes sense. That difference sounds small. In practice, it's everything. In the next part, I want to show you something even more interesting. Because there were actually several stocks that did qualify technically. Good companies, healthy charts, reasonable option chains. I priced them, I analyzed them, and I still chose not to open the trade. Not because they were bad trades, because they weren't good enough. Let's look at those next. Now let's look at one that actually came much closer. This is US Bancorp. From a business perspective, there wasn't much to dislike. Large cap bank, strong uptrend, earnings already behind us. ADX above 30. The strike sat just below the 21-day EMA, with additional support around the 34 EMA. On paper, this looked like a perfectly reasonable wheel candidate. The AI review came to pretty much the same conclusion. Assignment quality, good. Delta, right around 0.25, exactly where I like to be. Position size, just under 5% of available buying power, so still within my portfolio rules. The interesting part wasn't the chart, it was the option itself. Implied volatility, was basically in line with historical volatility, nothing special, and the bid-ask spread was surprisingly wide for such a small premium. At the current bid, the return simply wasn't attractive enough. The analysis suggested that this only became interesting around a 40-cent credit using a patient limit order. Below that, I preferred to keep my capital available. This is an important distinction. A good company doesn't automatically create a good trade. Sometimes the business is excellent. The chart is healthy. The strike makes sense. But the premium simply doesn't justify locking up capital. That's exactly what happened here. USB stayed on my radar. It just never reached my target price. Now let's look at CSX. This one was probably the closest to becoming an actual trade. The business quality checked out. The chart looked healthy. Earnings were already behind us. And unlike some of the earlier names, this wasn't an extended rally. It was a normal pullback into support. Price was pulling back toward the 21-day EMA, while the broader uptrend remained intact. ADX stayed above 20. RSI of 2 was actually oversold. From a technical perspective, this was exactly the kind of chart I'm looking for when selling cash-secured puts. The AI analysis reached the same conclusion. Assignment quality, good. Trend, bullish. No earnings risk. The only real question was pricing. The $50 strike sat right around support, but the delta was roughly 0.33, a little more aggressive than my preferred range. The premium was fair, not exceptional. At that point, I had two choices. Take the trade, or wait for either a better premium or a slightly lower strike. I chose to wait. Not because it was a bad setup. Actually, I think it was one of the better opportunities of the week. It simply didn't offer enough edge for me to commit capital. Sometimes the best trades are the ones you execute. Sometimes they're the ones you almost execute. This one fell into the second category. There were also several stocks that never even reached the AI analysis stage. Names like Exxon, Merck, AbbVie, and Apple all looked interesting from a technical perspective. Exxon had a strong trend. AbbVie was pulling back into support. Merck would normally deserve a closer look. Even Apple made it through the initial filters. But they all had one thing in common. They were reporting earnings during the week I was evaluating new positions. For me, that's an automatic stop. The chart doesn't matter. The premium doesn't matter. The AI analysis doesn't matter. The trade ends before it even starts. That's one of the simplest rules in my process. If a company is about to report earnings, I don't sell a cash-secured put. Not because I think the stock will necessarily go down. Because the outcome becomes binary. The premium you're collecting isn't paying you for normal market risk anymore. It's paying you to take earnings risk. And that's simply not part of my wheel strategy. Sometimes the best filter isn't finding more trades. It's eliminating them before you waste time analyzing something you were never going to trade in the first place. So, 0 trades, no premium collected, nothing to add to the trade log. At first glance, that might look like an unproductive week. I see it differently. This week, the process did exactly what it was supposed to do. It rejected weak charts. It rejected poor pricing. It rejected earnings risk. And it rejected trades that were simply good, instead of great. That's something every systematic investor has to accept. Your edge doesn't come from trading every week. It comes from knowing when not to trade. Because every position you don't open leaves capital available for the one that actually deserves it. The market will open again on Monday. There will be new charts, new premiums, new opportunities. My job isn't to predict when they'll appear. It's to be ready when they do. And that's exactly what I'll keep doing. You'll find this week's trade log in the description. Every week, I publish the watch list before the market opens, and later I share the trades that actually made it into the portfolio. Because sometimes, the most valuable trade of the week is the one you never make.